Welcome. Today we're going to go over the top 7 frequently asked questions on DSCR loans. If you're new to our channel, hi, I'm Mike Bond. I'm here to help you with the knowledge to become a top real estate investor because I want you to make the money you need to live your best life. Now to do that, like, subscribe, and check out our other videos on this channel. So DSCR, debt service coverage ratio loans. They're loans specifically for real estate investors where we eliminate all the income issues and make it easy for investors. But what are the questions that mostly come up when we're talking to real investors? Is DSCR a long-term loan or more like a bridge loan? DSCRs are 30-year fixed typically. Yes, they come in some different forms, but these are your long-term hold loans. They're not your bridge loans to buy something, but they are the loans where you get into them and you typically stay there. So these are set up for investors as your long-term options. Number 2, can you use a DSCR loan to buy and flip a property? Technically you can, but it's going to cost you a lot more money because DSCR loans come with some uniqueness. And some of that uniqueness is typically they come with prepay penalties. They're not set up to be fix and flip loans because they require you to put 20% in no matter what the value of the property is. So if you bought a property to flip with a DSCR loan, you would have to put 20% down, and then you would have to cover all the cost of the rehab. On top of that, it's probably going to cost you more with that prepay over a bridge loan, even on the interest and the points. DSCR loans are not set up and should not be used for fix and flips. Number 3, with DSCR loans, most, if not all, come with a prepay penalty. What does a prepay mean? That means if you have a 3-year prepay and you pay it off, meaning you sell it or refinance it before those 3 years are up, you're going to pay the lender an exit fee, typically somewhere between 3 and 5% of the loan amount. So if you have a $200,000 loan and you pay the loan off early by a refinance or sale, you can pay them up to $10,000 in an exit fee, which is called the prepayment penalty. So DSCR loans come with 3 to 5 year prepay. Number 4 is what makes up a DSCR calculation. All they're looking for in a DSCR calculation is, does income cover expenses? So what they're looking at is rents. Do the rents actually cover their expenses? And when they're looking at expenses, all they're looking at is your mortgage, your taxes, your insurance, and your HOA. They're not going to take into property management or maybe some delayed maintenance. They're just looking at those 4 things. DSCR calculation just wants to make sure your rents are equal to or higher than your expenses. Number 5, how long do you have to be in business to get a DSCR loan? We all understand with some banks and even conventional loans, typically you have to be in business 2 years or have some track record. That's the great thing about DSCR loans. You can start the business yesterday and close on a DSCR loan. There's no business requirements because they don't ask and look at income from you personally or the business. They're just looking at the income from that rental property. So number 6, why is a DSCR loan better than a conventional loan? It's not always better, but in these circumstances, it is better. Number 1, like we said before, maybe you just started in business. You can't go the conventional or bank route. DSCR does not care. So they trump conventional and bank financing there. Number 2, income. Maybe you write everything off. Maybe you want to pay the IRS as little as possible. DSCR does not care because they're not going to look at it. Third, they'll finance up to an 8 unit where conventional loans only go up to 4. So you could either have a mixed use or a property that has up to 8 units and still use a DSCR loan. DSCR has its advantages over conventional. It's not going to be better rates, but it is going to be easier to qualify. So last, what are the 3 factors in being approved for a DSCR loan? It comes down to credit. What is your credit score? In this market, typically you'll need a 680 or above. The higher the credit score, the better the terms. Terms mean how much you have to put down or your loan to value and your interest rate and your cost. Your property must have income from it, and to get the best rates, your income has to be greater than your expenses. There are products out there when your income is less than your expenses, meaning negative cash flow, but you're not going to give good rates on a DSCR loan if it is below positive cash flow. The other main factor in DSCR underwriting is loan to value. So the more money or equity you have into a property, the better chance you have at getting approved, getting better rates and terms. So if you have a 60% loan to value compared to an 80% loan to value, of course that loan to value and your credit score and the income will determine if you could be approved for a DSCR loan. So these are our top 7 FAQs. If you have another one, reach out to us. We'd be glad to help. We do a lot of these. Now, to make life easier for you, we have a free download. But before we get to that, if you like this video, check out our other videos on this channel. Now for that free download, if you're getting into DSCR, if you're looking at it, you're going to have to calculate the DSCR ratio. We have a free calculator below that you could download. Use it whenever you're looking for a property, if you use us or if you use someone else. It just helps you to make sure that property is positively cash flowing and you're going to get the best terms from the best lender. Now, if you want to make more money, stick around. We'll see you on the next video.